Hi everyone, this is Cesar Pineda, Farmers Insurance Agent in South Norwalk, Connecticut. Today I'm joined by Jessica Hastings from Total Mortgage in Ridgefield, Connecticut. She's one of our longtime business contacts and a friend. So I'm very happy to have her here today. Thank you for being with us today, Jessica. Do you want to introduce yourself a little bit?
Sure, of course. Thanks for having me, Cesar. So my name is Jessica Hastings. I'm a mortgage banker with Total Mortgage. Total Mortgage is headquartered out of Milford, Connecticut. My office is out of Ridgefield. We're a direct lender, meaning we lend our own money. So we're able to control closing times pretty quickly. Our big thing is we can close a deal in 30 days, which gives a lot of buyers a heads up when negotiating, especially in this market.
Yeah, and how have you guys been during this craziness during the pandemic and everything?
We're very thankful, very thankful. We've been extremely busy. Our bank has already hit $2 million in closed loans. There's $2 billion.
Oh, wow. That's amazing.
Not the M word, the B word. $2 billion in loans this year. So our little office here in Richfield has already closed, I believe, over 115 million.
Yeah, and how long have you been there? I know this is basically your life. You've been there most of your life, right?
Yeah, so I'm actually lucky enough to work with my dad. My dad's been in
nice.
real estate for over 30 years. So I've been in this full time for about 2.5 years.
All right, so today is going to be a little different. As many of you know, I've been doing a series called Business Strong Connecticut, which is promoting local businesses. Now, Jessica needs no promotion. She's already blown up all over the whole state. But so today we're going to be doing a little quiz back and forth. She obviously knows everything about mortgage loans and anything to do with the mortgage industry. And I, of course, as you guys know hopefully a lot about insurance. So what we're going to be doing is a little back and forth quiz. I'm going to be asking her a question about mortgage, and she's going to be asking me a question about insurance, and we'll see where it takes us. So,
Oh boy.
So let me go first. What do I need to get a good rate on my mortgage?
So the big thing is credit score. If you're planning on buying a house, you should be planning 6 months, a year in advance, and your credit score is your biggest way to save you money each month. And over a loan, 30 years, even saving $20 a month because your credit score is in a higher tier than it previously was is a ton of money. So that's your biggest thing.
Follow up to that, what's your range of like this person will get an amazing rate? Is it like 800 plus or even a 700?
Anything over a 740 FICO score. So that's the mortgage FICO score. So insurance has one, credit cards has one, cars has one, but we go off the mortgage one, which is usually the lowest of all of them, and we go off the middle of the 3 scores. Credit Karma does not count.
Yeah.
Say that all day long.
That's important. Yeah, that's important because many people use Credit Karma and they think that's
Credit Karma says my score is this. No, Credit Karma doesn't use the FICO score. They use Vantage Plus, which doesn't.
I didn't know that.
Yeah, it's a good idea to just be able to see what's on your credit report, but don't find the score. So I tell people this all the time to ask, but how does credit score affect insurance rates?
Credit, so it's kind of complicated in the sense that it's not the same credit that you use, right?
Yep.
It's not the same kind of credit that you use to get a car, but there's something called insurance credit, which is basically tied to the same score that you have. So if you have a high, traditional credit score, you probably have a high insurance credit score. But things that people don't think about that can affect your insurance credit is late payments, just issues with billing with your insurance specifically that basically shows us, the insurance companies, that you might not be that reliable. And so therefore that's going to come into play. And then you might
They actually look at your past history of paying like your previous car insurance or your
again, not in the same depth. We don't do a hard hit or anything like that.
Yeah.
But all those things accumulate and they affect your credit score. And when you go look for insurance, if you have a high credit score, insurance credit score, then obviously that's going to give you a better rate. So, what should people know about down payment? How much does a person need for down payment? Everybody thinks 20%. Is that true?
Nope. So there's actually a lot of options out there for less than 20% down. As a first-time home buyer, if the loan amount is under $510,000, $400,000, you can put as low as 3% down for a conventional loan. So for an FHA loan, it's 3.5%. So I have so many buyers that just say, no, I'm not ready to buy because I don't have the 20% saved up. You don't need it. And the other big thing is people say PMI is so expensive, I don't want to pay it. If your credit score is strong, PMI is actually very inexpensive now. So I would do it all day long. I have someone buying right now in Fairfield County, a little over 500,000, and they're putting 10% down, and their EMI is $63 a month.
Oh, that's not bad at all. Wow.
No, and they're only putting 10% down for $63
Right.
a month. Keep the rest of that money in your investment account or your IRA where you're earning interest. So,
And follow up on that, because I actually happen to have an FHA loan for my first home, and I got PMI,
Yep.
but I didn't have as good of credit then as I do now.
Yep.
At what point should I try to refinance or do something to get those lower rates, or to just get rid of it altogether?
So FHA loans, you have mortgage insurance for the life of the loan.
Mm-hmm.
Actually, my first mortgage was an FHA loan because I had student loan debt out the wazoo. So the goal with any FHA loan, I always tell borrowers, is your goal is always to refinance into a conventional loan so you can get rid of mortgage insurance. So typically we see the benefit usually within 3 years. This is a question I always seem to do research on. What coverage should I have on my house and my car? How is
Okay,
that?
so
What makes sense? What should people really have?
you kind of have to know what you're working with, right? If you are somebody who owns a home and maybe some other properties, and you have a business, you have a lot to lose, basically, right? If you ever get sued, people are going to see, hey, this person has all these things, let's try to get as much of it as possible. If you have a lot of exposure, you want to protect yourself with higher limits. That's not to say that somebody without those kind of exposures should have less coverage, because never have lower coverage, the more the better. But obviously, the more coverage, the more the rates. So if you're somebody who owns a house, traditionally for car insurance, I would recommend at least 100, 300, 100. What that means is that if you hit somebody and that person is hurt, if it was only one person, your insurance will pay up to $100,000. If it was 2 or 3 or more people, your insurance will pay up to $300,000. And if you total someone else's car, then the insurance will pay up to $100,000. So just to put that into perspective, living in Fairfield County, if you hit a Mercedes or a BMW, the car could easily be, 80,000 to 100,000. And if you carry low limits, like many people in the state have the minimum required, which is 25, 50, 25, that's not even going to cover half of it. And so you're going to be left with a huge bill. And unless you have that money saved up somewhere, they're going to come after your home. They're going to come after your business, any earned wages, anything they can do to get that money from you. So anybody should have as high coverage as they can afford. But if you're somebody who owns a home, you should at least have 100, 300, 100. If you're somebody who, is a target for people looking for lawsuits, you should have at least 250, 500, 100, and a $1 million umbrella, just to make sure that you're completely secured. That's on the car side of things. On the home, obviously every home is different. We go based on the coverage, based on the value of the home, not to sell or to buy, but to rebuild. So if that structure collapses, you want to make sure your coverage reflects how much it would take to rebuild that same structure. That number often is very different from how much you could buy or sell the house for.
Yeah.
So you always have to make sure that it's the right amount. Even if you could buy the house really cheap, but to rebuild it, it costs, a lot more. You really want to go by this number, because this is what's going to ensure that you have the same house if you lose everything.
Yeah, that makes sense. A lot of times I'll get buyers who give me like an insurance quote from someone online that you've never heard of, or big companies, and they've never talked to someone and kind of explain their situation. And then I get their quote and I'm like, I look at it and it's like the replacement cost so low that just knowing the cost to rebuild in this area, there's no way to even rebuild half the house for that cost. But they're about saving that, $8 or $10 a month, where if something actually happened, they're not going to have somewhere to live.
Exactly. And unfortunately, our society is so obsessed with price that they often look only at the price, and they don't actually look at what they're getting for that price. So at that moment, they're happy because they're saving money. But when they actually have to use it, that's when they end up upset.
Yeah, they actually need someone to get a hold of. It's like they can't get a hold of them, or they're frustrated because they're on their phone for 4 hours. That's why I always tell people what you pay for.
and to inject myself a little bit here, this is why a local agent, right, as Jessica just mentioned, you have somebody to call. When you have a 1-800 number, you're passed around from department to department to department to department, waiting around for hours to get to the right person. So with us, the difference is that you're calling my agency, or you, as a matter of fact, you could come in person to my agency, and then we could address any of your needs. So if you have an issue with your coverage, if you have an issue with your billing, if you have an issue with obviously a claim, but yeah, I mean, the difference is you get what you pay for, and sometimes it's really not that much more.
No, service is everything.
Yes.
So.
All right. So moving back to mortgages. So should I choose a fixed rate or adjustable rate mortgage?
So the answer to that is it really depends on your appetite for risk. So it depends on that and how long you're going to be in the house. So in the past, there weren't as many options for adjustable rate mortgages, or ARMs, which we call them in the industry. But nowadays, there's more options available. We actually have our most popular product, actually a 10-1 ARM. It's a jumbo product. So Fairfield County, that's a loan amount over 510-400. So our most popular product, so it's fixed for 10 years and then it adjusts, and it's lower than the fixed rate. So most people, per studies in real estate, stay in the same house for no more than 7 years. So you have to look at that and say, how long am I going to be in this house? And what's the loan? If you're buying a house with a $200,000 loan and it's your home for the rest of your life, then you should be getting a fixed rate. But it really depends on each individual circumstance. So that's why if someone has that appetite for risk, we always do a side-by-side comparison so they can figure out what's best for them. How does filing a claim affect your insurance premium? Does it always make it go up? Like, what if you file a glass claim? Does it make your insurance go up?
That's a really good question, actually. So everything that you file, as small as a glass claim or a tow claim, is a claim. And yes, it can affect you. However, that's not to say that if you file a glass, replacement claim once, that's immediately going to skyrocket your rates. No. The way we look at it is accumulation, or how much money is being paid out, right? So the whole thing is a very simple equation. How much are we charging you versus how much are we paying you if you had a claim? If we charge you $500 and all of a sudden we paid you $25,000 in one claim, who's losing in that equation, right? So that's what we're looking at. We want to make sure that it's even, that if we're charging you a certain amount of premium, if you file a claim, that's not offsetting how much money you are paying for by a huge margin. So, one way we could look at that is, again, accumulation. So if you're somebody who's filing a glass claim every month and you have 20 glass claims in 1 year, you're going to see the results. You're going to see your premium change because of that. But if you're somebody who has one claim once and it happened to be a really big claim, you might also be affected. I see this happen all the time. People are like, I've never had a claim in my life until now. And they're still very upset because they think that, the fact that I didn't have any claims during the last 10 years means that this $80,000 claim that's being paid out right now is just going to be like, oh, no problem,
No problem, just one.
It just doesn't work that way, unfortunately. It is a business. Ultimately, we are a very fair business in the sense that we look at how much money is coming in, how much money is going out. If we ever have an offset, like we did during COVID times, we are able to do something like, the credits that we gave a 25% credit on the month of April and a 15% credit on the month of May because people weren't driving. So if people aren't driving and then there's no claims, then we're basically left with all this extra money, and we're saying, hey, we're going to share with your clients because we want to show you that we're not, just greedy, and we're not just trying to hold on to as much money as possible. We understand that, especially with the whole situation, a lot of people needed, a break. And so, farmers, my company, I'm super proud of us because we're very human in that sense. Like, we get it. We're not just trying to milk it for money. We get it. But going back to claims, one big thing I want to mention is we do have something for car insurance that is an endorsement. So it's a special coverage that is accident forgiveness. So if you do have a claim and you're that person who never had a claim in their lives and they just had a little fender bender and you couldn't do anything about it, maybe you were backing up, you hit something or someone, hopefully not, and then nothing you could have done, farmers will actually overlook that as long as you have accident forgiveness in your policy. It is an extra thing, and it's something that not everybody's aware of. So through all these videos that I do all the time, I'm trying to make sure people are aware that there are things like that. Talking about pre-qualifications, that's a big part of your everyday life, I'm
Oh,
sure.
it is. It is.
Should you have a pre-qualification before anything else, or should you have a home before a pre-qualification?
So there's a big confusion in the industry. There's pre-quals, pre-qualifications, and pre-approval letters. The way
Mm.
is pre-qualifications are you telling a mortgage broker or mortgage banker what you make. A pre-approval is someone actually looking at your pay stubs, myself looking at your pay stubs, calculating your income, looking at your credit report, breaking everything down, making sure that what you're telling me actually matches the papers. Because a lot of the times people, they might not understand how their income affects a loan. So if you're a commission-based employee, you need 2 years at the same employer to use your income. So making $100,000 as a commission employee versus a salaried employee is two different things in the mortgage industry. So that's why I don't think pre-quals even make any sense anymore. You really need to be pre-approved. And a lot of the times, you can't even go in and look at a house unless you're pre-approved. And your agent has to provide the seller's agent a pre-approval letter. Because especially with COVID right now, there's no risk. No one's taking any risks. If you're not a qualified buyer, you're not seeing the house. So you absolutely need to get pre-approved. Yeah.
That's intense. So obviously a lot of things changed because of COVID, and that's a big one.
And the other big thing is most properties in this area are multiple offers. So if you're looking at houses before you're pre-approved, the likelihood of you seeing a house you like, going to get pre-approved, getting the letter, getting it to your agent, by the time that happens, someone else might have already bought the house. Because most of the times, you can't get that done in an hour. It takes more than an hour. So the big thing is be prepared. Don't decide you're buying a house today and start tomorrow. You need to plan it out 6 months in advance. Oh, I actually have one urgent question. Sorry, I always certain colored cars cost more money. Is that true?
No, I hear that all the time. That might have been true at some point when there were no colored cars.
Yeah. Like never buy the red car because that's going to cost you more per month.
No, yeah, that's absolutely false nowadays. We have every type of color nowadays. Like you see my car's wrapped purple and white.
Now, what color do you label your car as with your insurance?
I don't know, mixed color.
Right? Because yours is like almost equal.
Yeah, it's half white, half purple with a line in the middle that says homeowner business life,
Yeah.
But yeah, no, that's false. There are obviously fast cars that happen to be red a lot of the time. They're more expensive, but that's not just because of the paint. That's because of the fact that you're more likely to get into a big crash if you're speeding, and all of a sudden you total the car, and hopefully nothing happened to you. But if you end up hurt as well, Yeah.
All right.
Yeah, but good question. I actually
Always
done a lot, but I never had the chance to address it. Next question about mortgages. Foreclosed homes. How often does that happen that people buy foreclosed homes, and what should they know versus buying a traditional home in terms of mortgages?
So in terms of foreclosed homes, there's not as many options for you in terms of loans. The two big kinds of loans, conventional loans and FHA loans. Most foreclosures aren't going to qualify for an FHA loan because an FHA loan, we look at condition of the house more in depth than we do a conventional home. So anything that's a safety hazard, chip and paint is a big one.
Really?
Big one. So a lot of the times when you see foreclosed homes, they have those items or they have some kind of condition issue. So typically people get a conventional loan for that. Fun fact is the average foreclosure in the state of Connecticut takes 7 years. So a lot of the times these aren't fast items. Fast items in the sense that the house isn't on the market right away. It's going to be slower now with COVID because they're not essentially moving forward on any of those right now. So the thing with foreclosures are make sure that you have money saved up with those homes, because once you turn on the electricity, you turn on the water, you might have problems because typically people haven't lived in them for a long period of time. So if you're going to buy a foreclosure, just be prepared, have extra assets in the bank. look at options, maybe putting less down so you can have more reserves just in case. But yep, there are going to be more common, I believe, especially with everything that's happening in the economy. But we'll see, they're a hot item. People always want them. But
Yeah, and are rates higher, lower, or the same?
they're exactly the same. Yep. So rates change from a single family house to a condo. That's where we see a big change in the type of house that you buy in a multifamily.
Which one being better? Condos?
Nope, single family is the lowest.
Oh,
And
wow.
then multifamilies are right there. Not much of a difference. Condos are actually typically the highest. The
Oh,
secret
wow.
condos, if the title work reads PUD, Planned Urban Development, we can then lend on it as a single family rate. So that's
Wow.
something in this area, Rivington and Danbury. I don't know if you're familiar with Rivington over there, right off 84, the New York line. Part of those there are actually PUDs. So people are able to get lower rates than other people in the same association.
All right, guys. So I hope you learned something. These were pretty in-depth questions. Hopefully, you got something out of it. But if you need any more details for mortgages, Jessica is the person for you to reach. I'll put her contact information below. And for insurance, obviously, you can reach me at 203-803-2153. We'd be more than happy to go in depth with coverage, cost, and everything associated with making sure you get the best possible insurance policy for yourself and your family. So thank you for being with us today, Jessica.
Thanks, Caesar. Thanks for having me.
All right. And we'll see you in the next one, guys. Take care.